So I want to introduce everybody to our panel on insurance and bonding. And so we have two representatives here, Dave Bensfeld and Joe Bensfeld in the center from General Southwest Insurance Agency. And then we have Ted Edwards from Bonding Solutions, LLC to talk about bonding. Now, we earlier had a question from the audience about what if you don't have a vehicle owned by the company, do you still have to have liability insurance for the company on that? And Dave, I'm going to hand that question off to you.
So I looked at the ADOT contract, specifically ADOT, but any general contractor or will usually have that in their requirements, and it usually is $1 million of commercial auto liability coverage. So often they won't accept a personal auto policy, and often you don't have $1 million of coverage. If you don't have commercial vehicles, there's a fix. It's called non-owned auto liability coverage, and it's almost always available in one form or another. Or sometimes people title or lease one of their personal vehicles to the business and then buy a commercial auto policy just so that they can comply with the contract.
So that's a workaround for that issue?
Yeah, in addition, that non-owned and hired auto coverage provides coverage to your company in the event that one of your employees is using their own vehicle during the course of employment, runs into a busload of kids, and your company is sued because of that. Your company will be provided the $1 million worth of coverage to defend you or pay any claims that you're responsible for. So that's also very important if you have your employees, excuse me, out driving their own vehicles during the course of employment.
Good. Okay, you had a question?
Yeah, my question is, I'm an HVAC contractor, and I'm at the moment seeking for general liability and auto. I had a bad experience with my last broker, and we are parting ways, and it seems like I'm having the worst time trying to find people to cover me. I have no losses, yet one person gives me a quote which is totally double the amount from another person, and I need A+ rating companies. Why is it so difficult for my industry to pick up general liability and auto?
Well, there's 30 or 40 different companies that we represent that will provide coverage to contractors. A lot of agencies, some of the larger brokers, don't want to mess with the small guy because they have a minimum premium of $25,000 or more. So they just don't want to talk to you. We're a family-owned agency. We've been, second generation, been in business since 1969. And we do write a lot of small business because we feel there's a niche for it. There's a need for it, especially a need for it. And we don't want to be the big guy. We want to just be the guy that's there to help people out. We've got 23 employees with us, and we're proud of what we're able to do for the community. But, we can talk afterwards, but I can get you a quote tomorrow, no problem.
Okay, anybody else? Over there in the corner.
This question's for Ted. Can you talk a little bit about supplier bonding? That wasn't something that Philip had in his presentation, but you had mentioned it during our meeting. It might be useful for other folks here.
Sure. In this case, Amanda's company supplies different types of lighting fixtures and materials for contracts. And when we met, we spoke about different bonding options for her company. One of them was what's called a supply bond. Basically, it's a insurance product, which is what all bonding is, and it is underwritten by a carrier to ensure that, per the terms of the contract, her company will perform according to the terms of that contract, supplying the materials at the quantity and the quality and within the time frames that are required. It's not a real common type of bonding product, but we do see it on occasion. And it's underwritten and evaluated just like a bond would be for a general contractor or an electrician or an HVAC or a plumber. there's certain underwriting criteria that has to be met to qualify for that bonding.
Good. Anyone else? Over there.
So we have a construction company. We have 1099 contractors that the state says they, as a single employee, don't have to have workers' comp insurance. My workers' comp carrier's not state fund, but they did an audit for us over the last year, and they came back and said that we now owe them because based upon the payroll reports, once we paid them, that we assumed liability coverage for them because they didn't have it for themselves. I'm just wondering how they can do that. If the state doesn't require them to have it, why should I have it on them when I already have it on my employees?
And this is about workers' compensation insurance.
Yes, workers' comp.
So were these individuals, or was it a, were you, each of these 1099s were individual, or they were a company or somebody who's employing other people?
Individuals. An example I gave was pickup work from a drywall. We're a contractor, so I would hire a drywaller to come in. He's an independent contractor. He may work for us for a week or a month, and then he goes on and does other work for another. And I sent him his W-2 for the amount of work that he does for us over the course of a year.
His 1099 you sent them?
Yeah, 1099, sorry. Sorry.
Very important there.
Sorry.
Very important. There is a form that the State Compensation Fund has come out with, which we've kind of altered, that will be an acknowledgement from that individual to you or to the insurance company that they are an independent contractor, understand they're not covered. Then armed with that form, then you can go and fight with the auditor and explain this. Now, and the determination you got from the state, that was from the Department of Economic Security or the tax folks, right?
No, this was from the workers' comp.
From the Industrial Commission of Arizona?
No, the carrier that we have, they're out of Salt Lake City.
Oh, okay.
We didn't use state funds, so our agent had us look outside of state fund. That's who we historically had used, and they said we can save you money, so they found an independent workers' comp carrier, and that's who we moved to. But then it kind of came back to bite us with this audit because they're saying that we owe them for all the 1099 workers.
So one place you can go to look at is the state statutes and the law, and that's right online, or we can assist you with that. Then possibly having that form signed and then coming back to the auditor and disputing it, and hopefully you have disputed it, or if not, I can tell you how you can do that. But once an audit comes through, that's not the law, or I mean, you have the right of disputing that audit, just have to provide documentation to them and make your argument as to why their audit was incorrect.
Thank you.
You're welcome.
Over here on the aisle.
This is more of a general question. Since workers' comp is required by the state, the insurance companies that offer the insurance, are the rates standardized or different companies offer different rates?
The rates, the NCCI, National Compensation of... Yeah, NCCI, it's a little easier. They come out with the suggested annual retail rate for the specific class code that you're using, carpentry or roofing or what have you. There are, I don't know, many carriers in town that will, or in the state, that will deviate using schedule credits. I've seen some companies go up to 40% off those standard rates. So yeah, there is competition. There's also what you call, if you've developed an experience mod, which is developed after a couple years in business, over 5,000 in premium, I believe, your loss ratio will, if you have a good loss ratio, have no losses over a certain amount of years, you'll have an experience mod, and that I've seen those go down to say 0.80 or 0.75. On the reverse of that, if you have bad work experience or loss experience, I just worked on an account that went from $30,000 to $100,000 because their experience model went from below 1.0 to 2.08. And the way the council is determining those rates, they've changed the computation, and it's very complicated. But essentially, it used to be if you had a couple small claims, it didn't really hurt you. If you had one big claim, it didn't hurt you too bad. But if you had a lot of claims, that the frequency really dings you on the experience rate. So if you got to manage that cost, because that can be huge in certain. I've seen it almost put people out of business recently. So there's alternative ways of managing claims that you can talk to your broker with, or the insurance company with, or we have outlets that we can refer you to. But that's a very, very dangerous expense that can go up substantially with that, and you're stuck with it for 3 years. So I would pay huge attention to that with your workers' comp.
So safety programs, even in small businesses, are critical. Is that what I'm hearing?
I have a question. We are a steel erection company, so a lot of the times the owner or the contractor will have a OSIP or CSIP program, which we initially take our estimated hours and give them a credit for carrying the insurance. However, it has come to our attention, especially this past year, since we've had 7 projects with these programs, and some of them very large, that when we fill out the initial application, they take that sub-blended rate and they apply it to the whole job. Well, as I understand it, as your payroll dollars increase, your rate actually goes down. And so they are now asking for credits from us after we are done with the job at that higher percentage. How do we combat that? I mean, most of these general contractors or insurance controllers will tell you, oh, well, you gave us that sub-blended rate, it applies to the whole project, even though that's not necessarily true. If you were to audit the program after the fact, our insurance rate actually was down, and they actually end up getting more money back than they should have. And we've never received money back on these programs, ever. We've always paid more. Is there a way to combat that at all?
Is this on workers' compensation?
It's on both.
Or,
most
and
of them are
liability.
work comp and GL.
Okay. Because, I mean, it's true, there in workers' comp, there's this discount once your premium's over $9,000, where it's a flat, I think 9% it's kind of like a volume discount, where every dollar you pay over that is 9%. And so, that does grow. If somebody comes to me, I give them their rate as it's on their policy, but if their payrolls go up, then their effective rate goes down slightly. In general liability, that's generally not the case, that the higher your volume in a particular policy year, the lower your rate per thousand of payroll or cost of subs. So, but they're coming back to you and saying...
Well, like for instance, we initially, on our initial application, gave them X amount of dollars as a credit for the contract. Well, since we've done so much, we have 50 change orders on this one job. So they've come back and said, you owe us $9,000. And I'm saying, no, we don't, we owe you $4,000. And I can show you how we owe $4,000. But they're saying, no, your original sub-blended rate is what applies to your payroll dollars, because they're taking our payroll reports and applying that percentage to those figures. But in all honesty, if you calculated it all out, again, it's that sub-blended rate actually went down because our payroll went up. You see what I'm saying?
I guess it's a matter of what's in the contract, your contractual language with your contract with the prime or whomever it is. And if it's silent on it, then it would be a matter of your contract does not say that.
So you're saying to go back to the contract documents and look up and see what the actual verbiage is to distinguish whether or not.
Yeah, generally the liability rates are set at the beginning of the OSIP or RAP or whatever, and they don't change. The premium will change if your payroll is higher, they're going to charge you more, but at the same rate. And if it's lower, they're going to bring it down at the same rate. But generally, the ones that I've seen, it's pretty much a fixed rate. It's based upon, the premium's based on sales, not payroll, for the general liability limit. So I'm not quite sure.
Talk to me about a liability insurance umbrella. What is that exactly, and how does it work?
Well, the umbrella is a separate policy that increases your liability limit over the underlying coverages, which would be your auto liability, your general liability, and your workers' comp employer's liability. Some people think an umbrella covers everything. It doesn't. The underlying policies have to be listed on the umbrella policy to be covered, but it's the insurance company's way of being able to increase the liability limits. Rather, generally the most you get from a primary limit is $2 million. If you need a $10 million limit, then you have to buy the $2 million underlying policy and increase it with an $8 million umbrella.
The only thing that may relate to bonding with regard to an umbrella or general liability would be a Fidelity bond type product that would cover your employees for theft from your client's premises, or if you have contractors are doing work inside of a building, for example, in this hotel or conference center, it would cover some items that possibly wouldn't be covered under an umbrella or a general liability type policy. Those Fidelity bonds are typically written for smaller dollar amounts, not much more than usually 50 or 100,000. And they do provide some coverages that are not included in a typical umbrella type policy.
Okay, thank you. We had another question here, and I'm going to rephrase it a little bit, but I think the idea is, how do I find the optimum insurance agency to meet my company's needs? How do I shop for an insurance brokerage, other than making sure, of course, we call General Southwest, but you know, how do I find the right insurance company for my business, the right brokerage?
Well, I guess it's a complex issue. So you want somebody who has had some years of experience. There's just an awful lot of knowledge to acquire, and there's really not a comprehensive training education out there for somebody to learn all that there is to know about all the facets of property casualty. So you want to look for...
Unless you're born in the family business.
Unless you start as a janitor in high school, which was me, not him. But you're looking for somebody with years of experience, and then secondly, you're looking for a firm that has a lot of companies that they can represent. There's some very great agents out there who've set up their own shop, and they have just 3 or 4 or 5 companies to go to. They're great individuals, very knowledgeable, but they don't have a broad breadth of insurance carriers to approach on your behalf. And then I think your gut check. Does this person have my best interests in mind, or are they? Do they have a car payment they need to make and really need to get coverage in place for me? So those are, I guess, the criteria I would look at if I were in your shoes. Do you have anything to add?
Yeah, just make sure that individual has knowledge of your type of industry, whether it's contracting, sales, whatever. Make sure that they, ask them who they insure that are your competitors. If I'm not I don't specialize in any one particular area. I happen to do a lot of restaurants and bars. I happen to do a lot of contractors. I do a lot of light manufacturing. Dave does a lot of his own things, and we've got other agents in the office that kind of specialize in theirs. So when we run into an account that, I specialize in restaurants, Dave hands it over to me. He specializes in medical malpractice. I hand it over to him. There's just too many things, like you said, to learn. And I've been doing this 34 years, and I'm still learning, so.
Good. Yes, back there.
Got a question for you. As I was shopping around for insurances, I'm fairly new at this. I've had my prior insurance for the last 4 years in my business, so I've never really had to go through this. So it's been a heck of an experience here with the insurances. But I noticed that as I was seeking people to give me quotes, a lot of the people were coming back telling me, well, did you get so-and-so ready to quote you? I can't quote you unless you sign this document. Is there any truth, number one, behind that? And if so, why is that?
Well, insurance companies basically work on a first in, first out. So I represent 30 different companies, and my competitor does the same thing. If I go to them and say, I want you to quote ABC Construction, and I have the first complete application in, then any other agent that comes in after that, they will not quote for it because it's just too complicated. I might have different sales than this guy and different payroll numbers than this guy, and you didn't tell me about a loss, but he knows about one. So there's so many things that come involved in rating an insurance policy. If you have 5 different guys going to the same company with 5 different bits of information, you're going to get 5 different quotes and be confused as hell. So in order to alleviate that, the insurance company says, okay, we'll give you one quote. You pick the agent who you want to quote it from, and then by signing that letter is when you're picking that agent. Now, there's some agents that say, well, sign this so I can get you a quote, but he doesn't tell you that he's kicking me off the ladder. So it happens, but
Okay, here's a question I wanted to ask of Ted. What are some of the red flags that you see that is a problem with an application for a bond?
Well, we always try to make the red flags green flags. We'll work with the contractor in any way we can to try to get a bond done for them. Some of the red flags are unfortunately inherent in the contracts themselves. The way the contracts are structured, the type of work that's required, if there's a lengthy warranty period that's required as part of the contract, or the contract covers performance over a period of time, generally more than about 2 years, that sometimes can be problematic. And unfortunately, if that's the requirements of the contract, who you're doing the work for, those factors are sometimes non-negotiable, unfortunately. Those can make bonding a little problematic. The bond forms, there are, for depending on the work that's being done in a given state, there can be anywhere from 100 to 200 to 300 different types of bond forms that are required. Sometimes the bond form is problematic. Not very often, but that does become an issue sometimes. There are things as well within a contractor's financial condition that sometimes make bonding a little bit difficult. Now, that's one of those red flags that we like to try to work with them on to try to get them into a position where they will qualify for bonding. There's some minimum baseline type metrics that are looked at. One of those is the working capital that's retained within the company, the net worth of the company. I know there was a lot of discussion earlier about credit bureaus and credit scores. That's something that we look at very closely when we're underwriting any sort of a payment performance or a bid bond, is the credit history of the owners of the company and the company itself. If there's anything in those different baseline measurements that are problematic, then that can create a challenge. We've got, at least in our agency, we represent also about 30 or 40 different bonding companies, carriers, and we always have an option for any contractor that comes to us. It may not be ideal. It may require either some time that you take to get to the point where you can be bonded, or some conditions and terms within that bond offer that can be a little tough to qualify for at times. Funds control, collateral for a portion of the bond amount. But also, one of the benefits that we have is our agency is certified as through the Small Business Administration in their Surety Bond Guarantee Program. And it's a really good, robust program that the SBA has put in place that allows the SBA to participate in a portion of the risk of that bond, and in some instances up to as much as 90% of the risk of that bond is taken on by the SBA. Generally, they'll take on at least 70% of the risk of that bond. And that's a good program to keep in mind because it lets some contractors that wouldn't qualify otherwise for bonding get a bond on a contract.
Do you guys have anything to add to that?
I would just like to mention that the biggest problem I see for contractors right now is that they don't have valid contracts with their subcontractors, which makes them responsible to name them as additional insured with primary and non-contributory wording, waiver of subrogation, blah, 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 the list goes on. And if you don't have that contract in place with your subs, if you're subbing any of your work out, their insurance policy may not respond to the claim. So in other words, if the roofer caused the problem and the roof itself isn't going to be covered, but the damage resulting from the crash is covered, and your subcontractor that did that, you didn't have a contract with him, even though he gave you a certificate of insurance that says you're an additional insured and or loss payee and or excuse me. If you don't have a valid contract in hand, his policy is not going to respond to that, and not a lot of people realize that. And I think you need to go back, and I think AIA has a very good subcontract agreement. Use it. It may cost you a little money. Modify it a little bit. You talk to your insurance agent. What limits are required by your company, and I just don't think there's enough of our people notifying their clients that these exclusions or recommendations or requirements are required in order for them to have coverage, even though you have that certificate of insurance. I would get you 50% of the certificates of insurance out there are really not valid. The other thing I would mention, just in closing, is if a lot of you own your own businesses and you have a company vehicle on your commercial policy, but you don't have a private passenger vehicle insured, you need to add drive other car coverage, which will provide coverage for you in the event that you rent a car or borrow somebody else's car. You have additional coverage for the $1 million limit or whatever you've got. Normally, if you rent a car and you have a private passenger vehicle insured elsewhere, that policy will follow you. But when you rent a car from Avis, you're only getting the minimum limits in Arizona are 15, 30, and 10, and that's not going to pay for anything. So if you're in that situation, be very careful to make sure you add that to your policy. Maybe $100 a year, but it's going to save you a lot of grief if you need it.
That's really interesting. How many of you have other subcontractors that work for you? A few of you do. Do you have those written contracts? You do. Some don't. So, and you get that standard form at AIA, which is architects.
American Institute of Architects, or some small, some subcontractors associations, I think, may provide it as well.
Cool. Boy, I didn't know that. Okay, anything else? Okay, well, thank you all for coming here.